Welcome to Real Cash Flow, the only show that takes you full circle with your money, covering stocks, bonds, commodities, currencies, crypto, insurance, and real estate. I'm your host, Andrew Michael Arroyo. Let's get started. Welcome to the show. We are in part 2 of our 360 journey, going full circle in your portfolio. We're in the third quarter of 2024, so we're taking a holistic view of what's hot and what's not. Now, the metals have been hot, and we talked all about that last episode. If you haven't had a chance to see what's going on with gold and silver, I would encourage you to rewind to the last episode and listen to that first. And then we poured into the Fed funds rate and what's been going on, the US dollar, what's been going on with the currencies and how that affects the gold, the silver, and all the other asset classes as well. This episode, we're going to dive into the yield curve and bonds, and we're going to talk about the indexes. If we get to it, we'll get to commodities and we'll get to crypto. If not, we'll make a part 3 on that. But here's the breaking news. The Federal Reserve has dropped their interest rates by 50 basis points, 0.5%, and declared to the world that they are reversing course with their interest rate policy. So that's good news for some industries and not so good news for other industries. But where you can see the effect in all this is really the yield curve. And historically, if a yield curve is steep, and that means that the Fed is loaning money at one rate and then the further maturity date of whatever you park your money in, like a 2-year or a 5-year bond or a 10-year bond, you should be making more money as you put a further maturity date out there. It makes perfect logical sense. If I put my money in the bank and I can get 5%, well, if I tie it up for 2 years, I should get 6. Or if I tie it up for 10 years, I would hope to get 7. Or 30 years, I would hope to get 8. But in the last decade, or even really 2 decades, what's happened is we've ended up with a flat, or what's called an inverted yield curve. And sometimes inverted yield curves do lead to recessions, which is never a good thing. But even a flat yield curve, it discourages investment. Why? Because if I can get the same money parking my money in the bank as I could investing it for 30 years, I would not invest it for 30 years into a bond. I'll just simply park it into the bank. But we have seen finally a positive yield curve recently. So I am joined in the studio by Jason Riehl. Jason, welcome to the show. I want you to discuss and share what you see as far as the yield curve and where we're at today.
Right. That was a good breakdown as far as why people do what they do with their money. But yeah, it is an interesting time. It's an inflection point as far as the yield curve going positive after being negative for almost 2 years. And I believe it's the longest time in history that we've had an inverted yield curve. So I don't know what that's going to mean, but pretty historic. Then just as of this last month, within the last month, we've gone positive. And when that happens, that's usually there's usually a shift. It's an inflection point that shifts something to take note. And in history, it just has not been good for financial markets for whatever reason, for multiple reasons, I guess. We'll have to see what happens usually they lead, or these happens when we are actually in a recession. And as we were talking about in the last episode, that there's been a lot of anecdotal and actual numbers that have come out this year that the economy is slowing. And that's led up 9 months into a yield curve uninverting. So it's just something to keep an eye on. And if you base it on history, then there should be, get ready for some turmoil because things are adjusting.
That's right. And what's staggering, and I'm sure the Federal Reserve and economists will be studying this for years, is that if you look back in history, and let's just look back at the last 25 years, there's been 3 significant times with an inverted yield curve. In 2000 and 2001, in 06, 07, 08, and then very, very briefly, slightly, in the pandemic in 2020. But in 2000 and 2001, when it was inverted, there was a deep recession that followed, to Jason's point. And in '06 and '07, when it inverted, well, there's a very, very deep recession that followed in 2008 and 9. Now, this time it inverted between 2022 up to 2024. It went negative, and we don't know the consequence. But what we do know is that it was inverted for the longest period in history and also the most negative in history. And so the consequence could certainly be cataclysmic. We will know that in 3 or 4 years from now. And there's a lot of discussion. Did the Fed, hike those rates too fast? Did they leave them so high too long? No one knows. They're doing the best they can to juggle the economic data and make decisions. It's going to be a very fascinating period of history over these next few years, is the bottom line.
To say the least.
So, Jason, what's your thoughts looking at the history of potentially how steep they're going to need to make the yield curve in order to stimulate the economy?
Every action has an opposite and equal reaction. So if we're calling the action the inversion of the yield curve for close to 2 years, the reaction now is when we are uninverting, and depending on if and how much the economy slows down, or what other things are coming down the line that we don't know, are they going to drop it back down to zero again? I mean, you don't. It's obviously in their plan. They say that they don't want to do that again, but that's something that could happen again, and I don't know what that would do to the markets or whatever. What's one interesting take too is, since we're on we spoke about the Feds cutting their rates in the last episode, and they did have their first 50-point rate cut in September. The interesting fact is the 10-year actually is up since the time that they've lowered the Fed funds. Fed funds are overnight rates, bank to bank lending. The 10-year is what your mortgage is pulled from. So the fact that they lowered their rates, but the bond rates went up, seems like a little inverse reaction to where you thought it would do the other. So even though the banks lowered the rates, it's still got a tad more expensive for you to borrow money. So we'll have to see how that plays out too.
And that's a good segue into bonds. The one thing I would mention for people to take a close look at in the currency world is the Japanese yen, because if you understand the yen carry trade, you can Google that and figure out what that is. But essentially, Japan is the case study for what happens when you just overinflate an economy and then try to correct it with interest rate policies. They had to go to negative interest rates. They actually had to go less than zero, which we've not had to do. And we may have to do because of what Jason was just saying, the action and reaction. If we went to this inverted yield curve for 2 years, and this is experimental, and their reaction is a decade, a 6 to 8 year reaction, which we saw in 2001. And the reaction to that was about a 6 year repercussion. And then we saw it again in 2008. The reaction to that was just, we had to leave interest rates at zero. The Fed had to leave them at zero for almost 10 years. It's incredible. So there is that possibility that we would actually have to go negative. But I want people to take a look at the Japanese yen. And the reason is because when markets turn and there is turmoil, you do see it show up in the yen, and the yen tends to appreciate, and we're starting to see that. It is at a multi-year bottom. There's no question about that. If you look historically, the yen has not been this low in the last 25 years. And if you look after '08, what happened is the yen went up about 50%. It had a nice rise, and you're just seeing a bounce off the fresh low earlier this year. Looking at the Japanese yen in the Forex market, trading around 70 right now, but its high has been as high as 130. So when we talked about the US dollar in the last episode, one thing people can pay attention to is what's going on with the yen, because if the dollar drops, you'll see all currencies rise, but the yen because of the yen carry trade and its affiliation with the dollar and those interest rate policies, it tends to be the best indicator to look at. But let's transition over to the bond market. You mentioned the 10-year. Yeah, it's an interesting situation. Everybody hears this announcement and they go, great, 0.5% off. Let's go and refinance. And then wait a minute, rates actually went up. Why is that happening? And I like to, and we did an episode on this recently in our Federal Reserve explanation just to debunk some of the myths. But the bottom line is the Fed does two things. They cut the rates for the bank to bank lending, the overnight lending, but they are also the largest holder of our treasury. So they are actively buying and selling 10 and 30-year bonds constantly. And that's where I get a little frustrated as a citizen in a quote unquote free market capital society, because it's not exactly free market if a government entity, and they're not, it's a private slash public organization. I get that, but they have that much influence and they can just decide the next day, they can cut rates one day, and then the next day they can decide to sell a bunch of bonds. And then that drives up the yields, which effectively does not help the borrowers for mortgages, like Jason said. So we don't know, we see it quarter to quarter what the Fed's balance sheet looks like and how much they've actually sold, or how much, if they're going to do quantitative tightening or they're going to do quantitative easing. But they do have the opportunity, if they so choose, to buy up a lot of bonds to push those long-term rates down. And that stimulates a lot of growth and people being able to borrow at less interest. So when you look at that 10-year, yeah, it's pretty staggering because it took a huge jump up, like 5-6% in the last couple months. And obviously it's a reverse course. But anything else on the bonds that you wanted to cover? You and I for years have tracked this stuff. It's interesting to see the breakdowns that took place over the last 2 years because of that aggressive interest rate hike. I mean, it took down almost like a 20-year trend that was going up, up and away because the Fed just kept buying and buying those long-term bonds to keep rates artificially low. But now that they're not doing that, the big question I have is, are they going to be big enough moving forward to control that market? Because if they're not, we could see inflation rear its ugly head once again. What are your thoughts?
I'll refer back to the charts. They're just telling me that, I mean, these bonds have been in a decent downtrend for, since 2000 and whatnot, which, obviously is inverse from the rates, but we might get a little respite. But the long-term trends on the yields of these bonds still show higher prices or lower bonds yet to come. So, and if you've had bond prices that have been falling for 4 or 5 years, you know, as they, who's going to buy them? And then the people that bought them, when they get a chance to get out, they're going to want to get out. So I just think we have a lot of overhead supply with the bonds. I just don't, the trend seems higher for rates, which seems opposite since the Fed's lowering them, unless they're going to step in and like you said, buy the bonds. But on the other side of the balance sheet, we have the U.S. government has asked us to purchase a lot of things on debt. And in order to do that, they have to issue more bonds. So it's very tough on one hand to be issuing bonds to pay for things, whether it's services for citizens, services for other countries, services for wars. That money, in order, we're running a deficit. So there's no money to pull out of the piggy bank and spend. It's all being printed. So I don't know how you're going to continue to issue bonds and at the same time have rates go down. It's just it's a weird position. It's a talking about getting backed into a corner.
It's a catch-22, and something's going to give. And I think we just saw the beginning of that the last couple of years, is that these markets, especially the bond market, are going to get a lot more volatile than people have experienced in their lifetime. We saw it if you were, trading and doing things in the 70s and 80s, you might have seen it then, but then for the most part, it's been up, up and away, and technology has ruled the day. And yes, there's been some periods, 1987, 2001, 2008, 2020, but these are just small periods and quick recoveries, and then you just keep moving up. The bond market is so massive that if there is that level of volatility, I'm super curious to see the impact on equities because historically people get out of equities, they dump into bonds for safety. But if all of a sudden the bond market is not safe and it's volatile, where do you go? I mean, you go to hard assets, you go to commodities, you go to real estate. And that is my forecast. I think that you're going to see a lot of hard assets come online. You're going to see more speculators and more people own commodities and real estate than they've owned in the future. Now that you've got fractionalization and digitization of real estate assets coming online, and I mean, people can go to Costco and buy an ounce of gold. It's incredible, and they're sold out constantly. So the trends are there, and that's why we're hoping to wake up the audience and the listeners to say, there's a tsunami coming, and you see it, and it's going to be reshaping where people are putting their money, the old, 60/40 stocks and bonds. Yeah, I'm not sure that's going to work moving forward at the end of the day. But as we transition over to the commodity sector, any final thoughts on yield curves and bonds or any other rate comments before we move to the hard commodities?
Well, just you can. It's been a long time, but the only constant is change. So maybe it's time for a change in how you view the bonds and or how they're going to act, like you were saying. So
Indeed. Well, let's get to those hard assets. We talked about gold and silver in the last episode, so we're not going to cover that. But I do want to talk about the grains because a lot of people don't understand that that is a potential investment vehicle. And you've got soybeans, you've got corn, you've got wheat. Those are the predominant ones. There was some crazy markets that happened earlier this year in coffee, for example, and cocoa. And if you follow financial news, you probably heard about those. But those are a little bit less liquid and not something I'm advising people to go rush into unless you really know what you're doing. But soybeans and corn and wheat that do trade very liquid in the futures market, and there's now ETFs in which you could buy this, and there's companies that are attached to this. So whether it's energy, whether it's grains, whether it's metals, remember that if you don't feel comfortable investing in the actual raw commodity or the ETF that's attached to the commodity, there are companies that their revenue and profits are directly correlated with the underlying commodity. Gold miners, silver miners, for example, all the food companies that are out there for soybeans and wheat and corn, the price of their raw material has a direct impact on their profits, their earnings per share, etc. Energy, obviously oil, natural gas, etc. That is all tied to pipeline companies, drillers, distributors, gas providers, etc. So whether or not you actually invest in the underlying commodity, we still encourage you to understand the charts and the fundamentals and the technicals that go behind the underlying commodity because it will make you a better stock investor. So let's start with the beans, the corn, the wheat. It's been an interesting run because in 2020, we saw, a big reaction because of the supply and demand imbalance. And soybeans, for example, had just a marvelous run 2020 to 2022. But then it's really just been down and out ever since. We haven't seen the follow through like we did with gold and silver in the grains at all. But grains, when they do run, I mean, you can double your money and get a 2x over a 4-6 month period because of the supply and demand imbalances. So when you look at the charts, Jason, and you've been studying this stuff with me for decade plus at this point, there isn't those new multi-year highs, right? It's been in this sideways trading range literally for 25 years. You've got in soybeans like a top of near 1800 and a low around 800. If you look at corn, you've got a top of around 800, 850 and a low around 300. And you look at wheat, it's the same thing. It's this huge, huge sideways trend. And you've got some really high peaks that go up to the 12, 1300 range and then down around the 400 range as a bottom. But yeah, any thoughts, comments? What do you see and what are you hearing on the grains complex?
grains specifically, yeah, those definitely a different personality as far as trading or how they move. So that's something to keep in mind. And we are at the lower range of it. So now the idea is just to look for, you look for upside and let the market pull you in if if these are vehicles that you want to be in. As they are part of the commodity complex, agriculture in general, that whole sector um, has been doing well. 2024 has been a pretty good year. There's an ETF, DBA, which is an agricultural fund that's been doing pretty well this year. So it's all mixed in here. I think there is a demand. I think demand will regain control on these grains as well. I mean, even from 2000, there's higher lows at least. So demand slowly picking things up, and as money moves out, if our theory is correct that there's going to be volatility in other places where there used not to be. There's this is one way to play it. I mean, I like versus playing the grains themselves. I like looking at it from an overview, which is like an agriculture fund or things in agriculture in general. That way, you don't have as much volatility, but you can still prosper from upside or demand or a shift into that type of investing.
And I think one of the frustrations for people at large, and I don't blame them, you hear this in the political arena, is the cost of goods, right? The inflation eating your lunch. Because when you talk about food prices specifically or energy prices, it is directly correlated to the raw material cost. And if you look at corn and wheat and soybeans, they all peaked in 2022. Yet we don't see any change in the price at the supermarket or at the pump. And that's a big frustration for so many that are paycheck to paycheck because it's half the cost that it used to be 2 years ago to produce or buy the bushels of corn, wheat, and soybeans. But the food prices didn't come down 50%. So we're trapped in this cycle of some inflationary environment where we get the markup as the consumer. And when the discount happens in the underlying commodity, the corporation just keeps the profit, right? They don't pass that on to the consumer. So quite frustrating. But with that said, is with any market, whenever you've hit a new high, a new peak, and people start to get acclimated to new prices, that's why inflation is so dangerous and people just keep driving the price up, up, and away. So we talked about with gold and silver right now not necessarily being a great entry point. Why? Because it's had a parabolic move and it's quite high. Gold, silver, they're both, breaking off to new records. Copper's down a little bit. But when you look at corn, you look at soybeans, you look at wheat, it's the opposite. You could buy a bushel of wheat, corn, soybeans today for literally the same exact price as you could in 2007 and even 2015. So the point is, when you're looking at multi-year trends, trying to figure out where you want to park your money, and you'll see this same situation going on in oil and energy right now. You want to look at what has not had the run yet, but has the potential to because the overall asset class is breaking to new highs in some sector. In the commodity sector at large, gold and silver are leading the charge. Very different from 2008, 2009, for example, and that whole run up in oil. So switching gears, Jason, to the energy complex, because again, oil is trading today at $70 a barrel. And with all the inflation that's been going on, I mean, where is it? It had 1 month in 2022 where it shot up from $90 a barrel to $140 a barrel. But that was 1 month. And then it just came crashing right back down. And of course, that's when the Fed was raising the interest rates. But if you look at light crude oil and you look at that historical chart, it's incredible to see that, yeah, in 2007 and 8, I mean, remember, oil was $150 a barrel. And then it crashed. And then you had a couple other crashes like the pandemic and all that. But here we are 20 years later, and oil's still at $70 a barrel. So, people talk about all this inflation, but it's like, well, according to the raw commodities, besides gold and silver, there really hasn't been a move. And that's a little scary. And I'll tell you why, because if indeed there is this underlying inflation and it's going to really rise, we haven't seen anything yet. A barrel of oil should be going for about $200 a barrel right now, and it's at 70. So that means if it's going to rise, just based on natural 3%, 4% inflation compounding over 20 years, we should have seen at least a double from 70 to 150 and at least a little bit more with all the financial news. So what are your thoughts, energy complex in general?
Yeah, it's been a little bit of a conundrum, because you thought it would follow everything else with this inflation, and it's literally been almost inverse or going the other way. So yeah, there hasn't been many plays in the sector, like a lot of, especially with the drillers and the guys that dig it up, and they're just the stocks themselves have not been doing well, even as its bull market has raged on, and made all-time new highs. They're not doing that. So, um, just what's the reason? Is there too much supply? Is there more supply than we thought? Like I said, or is it going to rear its head later on? Um, you don't know. One thing we were talking about, the grains before, and the grains as an input price, they went up for 2.5 years. Um, and during that time, the people that create the end products that you buy at the grocery store, were purchasing, let's say, 5 years ago, it was $1. 4 years ago, it went to $1.50. 3 years ago, it went to $2. 1 year ago, all of a sudden it was $4. They still have all the inputs that they bought, all the ingredients to make the things that you buy on the shelf at the grocery store. Their prices went up, and those prices that they paid for those inputs are still sitting in the grocery store or online to get there. So they're not going to discount their prices when they had to pay 2000 or 2022 prices for something. They're not just going to drop the price because that's already in there. They're just going to pass it on. So it's kind of like, was there a lot of oil? It's maybe a similar thing to oil. We have an oil glut. There's been so much oil that it's outweighed what's going on now. That's the scary thing about the Fed missing or being too late to get that inflation. As you were saying, prices get stuck at a high price. If inflation ticks up again, then all those, we're going to go through another wave. If they go down and there's maybe 1 or 2 years of decent prices that go into the products that you buy, but then they start ramping up again, then that's just going to lock in the current prices we have now. And you will not see any relief, at least not until whatever cycle gets extinguished. So oil's different, just because you figure with the geopolitical and just inflation itself, it has not moved. Is it a combination of green energy and less oil being used? But usually oil demand picks up a couple percent each year just based on people on the planet. So that's why it's good to follow the charts. I've just been staying away. There hasn't been many plays. It's been, if you're a range trader, it's been great. But I don't really do that. So we'll just have to wait and see. It's just a conundrum in my eyes.
Yeah, let's talk about crypto as we wrap up this segment here, because crypto has had an incredible return to the spotlight. It softened recently, but rewind a couple years ago, Bitcoin fell from 60,000 all the way down to 15,000 and then recovered abruptly, right, all the way back up to 70,000. And now it's just kind of in a sideways trend this year where it's bouncing around anywhere between 50 to 70,000. So in Ethereum, same story. There's certainly some potentially buying opportunities because you're not at the peak price, but these cryptocurrencies are tied to tech. That's one thing that 2022 taught us, is that when tech goes, crypto goes. And if that gets sold off, crypto gets sold off. So, for those who have not entered a crypto position, this is an opportunity to take a look and start to diversify and think about what is the one cryptocurrency you would like to own long term, and start to average in some pricing so that you're not subject to the crazy volatility, but also being prepared with cash. That's my personal plan, like it was in 2022, that when they do have the big fallouts, that I have a chunk of cash allocated specifically to go buy that fallout. So when we look at these markets holistically, the commodities that we've mentioned outside of gold and silver, we've got the grains, we've got the energy complex. You can go a little bit more sophisticated and dive into some other pieces of the commodity sectors, but just those two alone, my 2 cents, my preparation, my shopping lists are all based around what are the stocks that no one's paying attention to that are attached to those commodity complexes that have not had big runs, that are selling for very, very low price to earning multiples already. If we get a pullback in the general stock market, there's going to be even further discounting on those properties. So I've been looking at Brazil, Australia, Canada, all the rich producers of these commodities. And you can do your own research. You'll be shocked to see what is out there and some of the pricing on some of those substantial companies that have been discounted and they're trading at 5 times earnings, 4 times earnings, 8 times earnings, and they're paying 12% yields, 8% yields. I mean, incredible dividends. Those have, in my opinion, the greatest opportunity for a significant rise if the tech and AI boom cools and people start to get back to the raw commodities. So again, we study the charts of the commodities, but then we go and find the actual underlying stocks. And now there's all these ETFs that have come out for all the cryptocurrencies and Bitcoin. So there's no excuse not to have this kind of part of your portfolio. But Jason, as we wrap, any specific thoughts or stocks or underlying attachments that we can place to the commodities?
No, it is good. There are a lot of, like you said, companies that derive their revenue from finding, drilling, discovering, and then packaging and selling those commodities. So just look for the big market cap ones in the commodity in a sector that you're looking at. That is a great way to play it, leveraged, and you can, or the ETFs is another good way. They have some really good ETFs that you can follow that trend. So no, I'll just kind of agree with what you said. Not too much to add as far as that's concerned. And then as far as cryptos are concerned, they're still proving their worth. Things are still being worked on. I just dollar cost average into Bitcoin, about once a week, just trade some of my fiat for some digital currency. I don't know what you're going to call it, but framework for future money transfer, and there's some other smaller alts and things like that. But if you're new into it or it's something you want exposure to, just, kind of like stocks, look at the top 10 market caps and kind of delve in that way. But I think dollar cost averaging is the best way since they're so volatile.
It's great wisdom. And as we wrap up this episode, we hope it's blessed you and encouraged you to go find a shopping list of your own and start to raise some of that cash so that you're prepared. Tune in for part 3 of this episode. We're going to be covering the stock market indexes at large. See you next time.